Hello and welcome to the second edition of Taxes and Retirement Live. Thank you for joining. I appreciate you spending your Wednesday evening with learning something fun and exciting. I'm sure you were looking for something amazingly exciting to do today, and Medicare premium surcharges fit the bill, so thank you. Again, like last week, feel free to post any comments, questions as you have them. I will see them on my screen and answer them in real time. So this is going to be about Medicare premiums, specifically the what's called IRMAA, the income-related monthly adjustment amounts, which are income-based surcharges or additional taxes, however you choose to view them, on top of your regular Medicare Part B and Part D premiums. I just want to add some additional info about Medicare. I don't want to make this a Medicare primer. That's not why you all are here. You're here to learn about the IRMAA surcharges, but I just want to share a little bit of fun facts and info about Medicare. At least I think it's fun facts, but that's me. So Medicare is the national healthcare system for people over 65 or older. It started in the mid-60s. There's a few different parts to it, which you're probably aware of. There's Part A, which covers things like hospitals, skilled nursing facilities, certain in-home care assistance. Most people don't pay premiums for Part A. Those who worked paid Medicare taxes their whole working lives into the system. So for people, I think, who have 30 credits of work, which breaks out to 7.5 years, I believe, of work in which you paid Medicare taxes, you're in. You're qualified for Part A to get it. I wouldn't say free, but free of premium when you do turn 65. So that's Part A. Part B covers routine doctor visits, primary care, specialists, certain medical equipment, durable medical equipment. Also provides some certain types of in-home care. That is something that people do pay monthly premiums for. As of this year, 2020, it's $144.60 per month for your Part B premium. Some people may be slightly less. I don't want to get too off topic, but there's something called the hold harmless provision for people who are on Social Security already and getting Medicare. Basically, it says that Social Security usually goes up every year as their inflation. When there's years where there's no inflation, your Social Security payment stays flat and doesn't go up. What's called the hold harmless provision says that if you're on Medicare and Social Security, the increase in Medicare can't be larger than your increase from inflation on your Social Security. If it is, your increase in Medicare gets capped. So even though for everybody else it may go up a certain amount, if your net Social Security check would go down because your Medicare increase is larger than your Social Security inflation increase, your Medicare increase gets capped. Bit of a tangent, but the point is, it's not the same amount of premium for everyone. For most people it is, or at least the base premium of $144.60 is the same for most people, but not everyone in not all cases. So that's Part B. Part D, should you choose to get it, it's not mandatory, is drug coverage, D for drugs. That is, the premium's different based on what policy you get. There's not one single Part D. You kind of have to shop around and find the one that is best for you and covers the particular drugs you take, and then do cost benefit to weigh the pros and the cons and what's covered at what levels, etc., to pick the plan that's right. On average, I believe the typical monthly premium is about $30 per month for people who are on Part D. And then there's something called Part C, which is Medicare Advantage. That is basically like commercial insurance, like you probably know it. You have Aetna, United Healthcare, whatever. Instead of paying the Medicare system directly, you go through an insurer. Let's just assume Aetna. That's one of the more common ones around here in New Jersey. They bundle in Part B, Part A. Some may also include Part D, the drug coverage, and there may be other stuff as well that they throw in with it. What's slick about that is it's basically one premium. It looks and feels like insurance you've probably had your whole life, where you deal directly with Aetna. Behind the scenes, they're covering the Medicare portion of it, and also paying your Part B premiums, because the extra stuff they add is basically bolted onto the base Medicare levels of coverage. So that's Part C. Again, that's optional. You don't have to get that. It's increasing in popularity because it's kind of neat and easy and convenient because it's all bundled in one thing. So I mentioned the things that the parts do cover or generally cover. There's a lot of things that are specifically excluded from Medicare coverage. Again, if you get Part C from a commercial insurer, they may add some of these things in. But if you just have traditional Part A, Part B, maybe even Part D for drugs, things that are not covered by Medicare, hearing aids, basic footwork, podiatry work, unless it's like surgically necessary, you get in an accident, crush your foot, that's covered under Part A, but basic, foot care and maintenance is not included. Vision tests and glasses, not included. Hearing aids, not included. Dentures, not included. Long-term care, not included. So a lot of people don't realize till they get to Medicare, it's not this all-encompassing, covers everything. There's still lots of things you need to cover yourself, or get this Advantage Part C plan that bundles in some, if not all, this other stuff on top of your regular Part A, Part B. So, just want to mention that the premiums, so again, Part B is $144.60 per month this year. Those do get adjusted every year, and it's not just some random number pulled out of the air. The way the Medicare system does it is each year they anticipate what the average per person cost is going to be for all care administered under Medicare. The base Part B premium is set to be 25% of that. So do the math, $144.60 times 4, what's that, 400, $560-ish, $570. That's what the Medicare system anticipated the average per head for person on Medicare, per head expense would be for Part B in 2020. So 25% of that is what the premium's set at. Now, I have an interesting chart. Obviously, anyone who's followed healthcare expenses knows these costs go up. This is a recent report from the Medicare trustees just showing, here's my crude paper in front of the camera trick again. This just shows projections. So again, now it's $144.60, yeah, right there. It's anticipated that within 10 years, so 2029, the monthly Part B premium will be $234 per month. That's about 5%. Just realized the microphone's not on, so apologies if I sounded funny. Here we go. Wrinkles my shirt a little bit, but probably sound better. So it's clear costs are going up. Again, Part B expected to go up to about $234 per month within 10 years. Obviously, expenses are going to increase. Now, the whole point of today's live and why we're here is to discuss and learn about additional premium surcharges that are tacked on top of those base premiums I just discussed. These are income driven, so all else equal, the more gross taxable income you have, the larger the additional premium surcharge will be. And again, these surcharges are called IRMAA, Income Related Monthly Adjustment Amounts. So in addition to the base premiums projected to go up 5% per year, I have to assume these income-based surcharges will kind of go up as well. And maybe not in lockstep, I don't know, to be determined, but I would suspect they're going to go up. These surcharges came into existence. My wife just told me I still sound a little Tim-y. Let me just see. Apologies for the low production value of all this, but this is kind of what I envision with these lives. Let's just kind of turn the camera on, get some things to talk about, and see what happens. All right. I don't know. Hopefully that's okay. If anyone's having problems hearing me, let me know. If it's tinny or sounds a little funny, it is what it is. I'll see if I can fix that going forward. But for now, if anyone can't hear me, just send a chat in or a comment or something. All right. So again, these surcharges started 10-ish years ago, give or take a little bit, partly to help bolster and shore up the Medicare system. This is also funded, like Social Security we discussed last week. A large part of the funding comes from payroll taxes from those who work and pay taxes. A lot of it comes from the premiums as well. As I mentioned, $144.60 per month for people on Part B. Yes, so my sound is still scratchy. Okay. Let's see. I don't know. The other option is to unplug this mic that I have and just let the camera mic work, but I don't know if that's going to be any better. All right, so I'll keep this mic for now, see if I can figure out what the problem is before next week. Apologies for the bad audio quality. So the surcharges are based on a modified adjusted gross income. You may have seen some of my posts in the Taxes and Retirement group. Not all modified adjusted gross incomes are the same. Depending what particular tax provision you're discussing, they may generically use the term modified adjusted gross income as the trigger, the threshold setter. But there's slightly different tweaks and versions to modified adjusted gross income. The one in particular used to determine whether or not you have to pay these IRMAA surcharges is this. It's basically your regular adjusted gross income from your tax return, which you can find in 2019 at least on line 8B, and you have to add to that tax-exempt interest. Again, as we discussed last week, things like municipal bonds, bonds issued by state and local governments, the interest on those is usually not taxable at the federal level, may or may not be at the state level, but federally at least it's not. For purposes of modified adjusted gross income, for these IRMAA surcharges, you do have to add that tax-exempt interest back in. For those of you that are interested, that's line 2A of your 1040, at least on the 2019 version of 1040. These do and have been changing every year, so the line numbers may get tweaked going forward. So, based on your modified adjusted gross income, which I'll just call Maggie, save myself some syllables each time I say it, these are the additional amounts, or the surcharges, you'll have to pay. Let me get this straight. So it depends on your filing status, and this grid is in the video I posted on YouTube, and I think I shared it in the group. It's called Understanding Medicare Premium Surcharges or something like that. You can also find this easily, just Google IRMAA, IRMAA, or Medicare surcharges, and you'll find this grid. I didn't, there's no magic to what I created here. So based on your tax return filing status, if you're single or any one of these others, head of household, usually not going to apply to retirees, head of household and qualifying widow or widower. In both cases, you need a dependent that you're caring for, a dependent child or other dependent. So not going to qualify a lot of retirees. Married filing separately is possible. The gotcha with that, and married filing separately has lots of gotchas throughout the tax code. There's not a lot of situations where it makes sense if you're married to file separately versus as opposed to joint. But if you are married filing separately, you can't have lived with your spouse at all throughout the whole course of the year. If you did, and then you see the footnote here, you automatically get slapped at the highest thresholds, really punitive. So you better have a really good reason for being married filing separately, and do not live with your spouse at all throughout the course of the year. So just going back to a more simple case, let's assume you're single, and you have a modified adjusted gross income of $87,000 or below. You're not going to have any additional surcharges to your Part B or your Part D. But it's a little fuzzy. I'm trying to get this in view here, in focus. The next one, if your modified adjusted gross income is between $87,000 or above $87,000 up to $109,000, then you do start having surcharges. Specifically, you pay almost $58 more per month for Part B. I'm doing this backwards here, looking at the camera, trying to move my finger. It's a little weird. So that's on top of the $144.60 you're already paying. You're paying another $57 and change on top of it. And if you have Part D, whatever your premium is, again, the average I think is like $30 a month. You're paying another $12 and change on top of that if your modified adjusted gross income was between this range. Now, these thresholds are cliffs. whether you're $87,001 or $108,000 and change, you have the same thresholds applied. It's not scaled. It's not phased in or phased out. It's boom. You're $1 over this limit. You're in that threshold. You're in that add-on range, the whole $57 and change range. And then the same applies for all these other thresholds here. I won't belabor the point and go through each one. You can see it here. But these thresholds do get pretty punitive. If you're single and have over $500,000 of modified adjusted gross income, you're paying an additional $347 per month for Medicare Part B, and another, $76 and change for Part D. Now, for what it's worth, how they come up with these thresholds amount, again, this isn't magic, it's just they're making you pay more of what the total expected cost is. So remember I said before, the base Part B is set so that it's 25% of what the expected total Part B costs are per person for the year. These just ratchet up. So at the highest level, instead of just having you pay 25% by way of premiums, they set it to 85%. So if you want to back into and do the math, you can, but point is, they come up with these just by making you cover a larger percentage of the total anticipated annual cost. So like this one, for example, not a coincidence that this surcharge is to the penny the same amount as the base Part B of $144.60, because in this level of modified adjusted gross income, they have you covering 50% of the total expected cost. Again, the base premium is 25%, double that's 50. So it's not coincidence that this particular IRMAA add-on is exactly double the base premium. And then you can see for folks who are married and file joint returns, basically the thresholds are all, for the most part, doubled. The highest one of $750,000 isn't double $500,000, but the rest of them doubled. And then the premium amounts you can see. So these are per person. So if you're married and there's 2 people on Medicare, and let's say your modified adjusted gross income is $172,000, jointly, you will each have to pay an additional $57 and change per month on top of your base Part B premiums. Good? Okay, we have a question here. Let's see. So Shanna asked, we can hear you, great. Question, what in general is the difference? Sorry if I got too far ahead of myself without addressing this. The difference with regards to what, Shanna? Do you mean the actual surcharges that I just went over, or are you referencing something else when you're asking what is the difference? Okay. So those are the surcharges. Interesting thing to keep in mind with them is they're based on your modified adjusted gross income from 2 years prior. So why is that? So let's use 2020 as an example. Your 2020 Medicare Part B premiums and surcharges, if they're applicable to you, are determined at the end of the year before. So let's say December 2019, the Medicare system will determine the base Part B, and each person who falls under it, each person's respective IRMAA add-on. So that's done 2019 for all of 2020. In 2019, they go off of your most recent tax return on file at the time, because that's going to be your most recent official record of your modified adjusted gross income. So in December 2019, the tax return you filed in April 2019 is going to be your most recently filed return. That return is going to reflect information, your income information from 2018. Sorry, my wife just sent me another text here. Screenshot of a question, right, that I don't see, but looks like Shanna followed up. So the question is, so if my taxable income in retirement is under $174,000, no charges, question mark. Yeah, yes, let me qualify that. So if you're married and file a joint return, that's correct. The threshold is $174,000 of modified adjusted gross income. So you asked about taxable income. It's not exactly taxable. It's all your gross income, your adjusted gross income from your tax return, plus, again, the tax-exempt interest. So if you have municipal bonds or that's the most common one. I'm not sure what other forms of non-taxable interest there are, but if you have those, that gets added to it. So just worst case scenario, let's say you and your spouse are hovering right at $173,900 of gross income, so you're like, good, we're under it, but you forget you have $200 of tax-exempt interest. Well, that's going to put you over that 174. So don't forget that sneaky tax-exempt interest if you have any. If you don't, then yes, your regular adjusted gross income from your tax return, so long as that's under 174, actually up to and including 174,000 on the dot, you're good. There'll be no surcharges for you. Good question. So again, it's based on 2 years prior. So people who are currently paying a IRMAA surcharge now in 2020, that's based off of their, oh, here we go, I had to scroll down, I see your comments now, sorry. My wife just texted me, it's probably the same thing. Yep, okay, so she's letting me know, hey Bonehead, you have other comments. Those are my words, not hers. She just sent me screenshots, but, so sorry, I do see there's another question now. So do the MAGI brackets change? MAGI stands for Modified Adjusted Gross Income again. Yes, they changed this year. Prior to that, I think they were fixed for like approximately 10 years. Now, I frankly don't know going forward what the intention is. I don't think there are already plans in place to have this automatically go up each year. I believe, I don't remember where I heard or read this, but it was what I believe to be a reputable source about retirement planning stuff, was that the thresholds were just recently increased again this past year. The first threshold was like $85,000 for a while. That single first level, that was just up to 87. I think it's staying fixed. I think all the thresholds are staying fixed for a while. The intention is, like we discussed last week with Social Security, this is like a stealth increase tax, because if you keep these thresholds static, people's income, all else equal, should typically tick up a little bit each year. So every year, more and more people are going to get sucked into these because their income will probably go up from Social Security, goes up with inflation. People who have tax-deferred IRAs, 401ks that are 72 and required minimum distribution age, assuming they're invested reasonably well, those will go up. Therefore, the amount they're pulling out and getting taxed on will go up. So typically, people's incomes will go up, and with the threshold staying the same, more and more people are going to hit these thresholds over time. So I think the government's intention is to leave them where they are until enough people go up that they're capturing a certain percentage of the population with these. I don't know what that percentage is or the numbers behind it, but I think that's the plan. So to my knowledge, no anticipated changes now, but I would suspect at some point in the future, be it 5 years, 10 years, I don't know, these may go up. We'll see. Good question. Another question. So if I'm married and retired and I withdraw $100,000 from an IRA at the beginning of the year for spending that year, it's under the $174,000, so no IRMAA charges, question mark. Correct. So the $100,000 you withdraw from an IRA is gross income that will be included. If you don't have more than $74,000 of other gross income, taxable Social Security, pensions, annuities, even little stuff you have to watch out for, interest on bank accounts and CDs, right? Maybe it's only $100, maybe it's a few thousand, but those are things you don't want. You don't want to get knocked over a threshold because you forgot the $400 of interest on a CD. Capital gains. So if you have mutual funds outside of a tax-deferred account, those throw off capital gains every year. outside of your control. You own the fund. Even if you don't sell it, it's still going to generate some gains as the portfolio managers behind the fund do buying and selling of securities throughout the year in that fund. They pass those gains or losses onto you. So if you've noticed, if you have mutual funds, again, outside of a tax-deferred account, you're going to get a tax statement at the end of the year showing capital gains that you were stuffed with for that year. So yes, if you take 100 out, fine, so long as you don't have over 74,000 of other gross income or tax-exempt interest on top of that. So no IRMAA charges in that case. Good question. Next question. So do you report your MAGI to Medicare, or does it get pulled from Social Security automatically? Good question. It gets pulled automatically. Again, that's why there's this 2-year lag. So December 2019, Social Security Administration sets premiums and IRMAA for 2020 based on the most recent tax returns they have on file at the time, which are those people filed in April 2019. Those returns reflect 2018's, wages, pensions, whatever, your income from 2018. So you don't have to do anything. The government has it. It's shared amongst these various agencies. There's nothing you need to do. Next question: do you recommend Roth conversions, which would bring you way over $750,000 for a few years, and just take your punishment to be done with the IRMAA surcharges quicker? Yeah, that's a tough one. Could be yes, could be no. I don't know anything about you. This isn't specific advice to you, Marianne. It's a great question. 750 is a lot of conversions. Again, without knowing anything about you or your situation, I generally wouldn't think converting a lump that large, $600,000, $700,000, $800,000 in 1 year, is going to be wise. Not only will your income tax itself be real hefty for a year, if you are Medicare age, or 2 years before, actually, again, because these premiums are set based on income 2 years ago. Once you're 63, your income in those years start to count for purposes of these Medicare premiums, because you start Medicare 2 years later at 65. That'd be a tough pill to swallow doing that much, frankly. Now, I wouldn't necessarily let these thresholds, like the first one, for example, 87,000 income for single or 174 for married, I wouldn't necessarily let them stop you from converting more than that. Like if you already have, you're single, let's say, you already have $85,000 of gross income, don't think, oh man, I can only convert $2,000 to stay under this threshold. The difficulty and the finesse of tax planning is a lot of this is you don't know what's going to happen in the future, right? So like I mentioned last week, a leap of faith sounds bad and like it's just guesswork, but a lot of the tax planning is we have to assume taxes will go higher because of all the stimulus getting created now, and objectively we know they will be higher starting in 2026 when the Tax Cuts and Jobs Act expires or sunsets. Assuming no other changes, each tax bracket we have now is going up 2% to 3% per bracket. So converting $10,000 today, we know for a fact saves you, all else equal, 2% versus converting it or recognizing as income in 2026 or beyond. That's what we know at a minimum. Again, throw on top of that the economic difficulties and the stimulus money getting created from the printing press. I have to believe taxes are going to go up, whether it's regular income tax rates or it's changes with monkeying around surcharges like these, or changing how much Social Security gets pulled into taxation. Who knows? But I have to think there's going to be higher taxes. So with that said, don't worry too much about being penny wise, pound foolish. If you are single and have 87,000 of gross income already, I wouldn't, and you do want to convert some, I wouldn't convert only $500, because whether you put yourself again $1 over that first threshold or $22,000 to stay within the top of that first threshold, either way you're in that threshold and you'll be paying the $57.80 extra per month. So if you're going to get yourself in that threshold, go all out, like top up to that threshold, take advantage of it. That the more you convert, the more you're kind of spreading that premium that you're going to have to pay across a larger amount, as opposed to just converting $1 over and getting zonked with that $57 a month. That's probably a bad decision. If you're going to go over that threshold, go over it, buy more to kind of fill it up. Now, that's the lower thresholds. When you get to the point, as Marianne was saying, converting a boatload, $750,000 or more in a year, or at least having total income over that, I don't know. We need to see. The surcharges themselves may not be crushing. $347 a month more per person. That's I don't know, 15 grand extra for a year. You and your spouse will have to pay just in Medicare premiums. Is that worth it? I don't know. In the grand scheme of things, it's probably not horrible. If you're converting hundreds of thousands of dollars, think about the tax savings on that. But again, your regular income tax this year is going to be really high for doing that. So, tough to say. My general advice, don't let these thresholds, these surcharges, be the deal breaker that stops you from doing conversions. Definitely keep them in mind. Tax planning is lots of if this then that, pull this, tug that. It's hard to nail down a definitive answer that yes, this is the absolute best case now and will produce the absolute best case in the future, because we don't know. Again, all tax legislation is subject to change. We know what we know now, and we have expectations and assumptions that taxes are going to have to go higher in the future, so it's kind of a balancing act. Not a great answer to your question, but honestly, I think that's the best anyone can say. Anyone who tells you otherwise says, yes, absolutely do this, or absolutely don't do that, they're being too sure of themselves, frankly. But at a minimum, someone who's giving advice about how much you should convert would need to know you and your financial profile really well to know not just your current income, but project out what your income may be in the future between required minimum distributions, pensions, Social Security, whatever. So I can't, unfortunately, give a neat and pretty quantified answer right now, but good question, Marianne. Julia, what is the benefit of converting to Roth versus straight 401k or IRA withdrawal to your bank account from a tax perspective? Sorry, so Julia, is the question the benefit of converting versus not converting in a general sense? What's throwing me a little bit is the part at the end, the benefit of converting versus a straight 401k or IRA to your bank account. I'm not 100% sure where you're going with there. If you can just maybe expand on that a little bit. Thank you. All right. So the 2-year thing, and Julie, I'll go back to your question if you can just elaborate a little bit. Sorry if I'm not 100% clear on what you're asking. My fault. But in the meantime, I'll chug on with my 2-year spiel here. So again, start thinking about this stuff when you're 63, because 2 years in the future you'll be 65, and presumably starting Medicare. You can delay to the extent you're still working and have what's called creditable coverage through your employer, meaning your employer health plan. That is an allowable reason for you to delay starting Medicare when you turn 65. If you don't have other acceptable coverage and you delay starting Part B beyond your 65th birthday, technically 3 months after, but beyond turning 65, there's permanent penalties that will last. Specifically, it is for every year you don't start but are supposed to, your premiums when you do start will be 10% higher for life. So using 2020 premiums, base premiums $144.60. If you turn 65 this year and say, I'm going to wing it, I don't want to pay for health insurance, I'm going to wait till I'm 66 and then apply. When you do apply, your premiums then will be $144.60 plus $14 and change. Actually higher, because next year the base is going to be even higher, but whatever that is, you'll pay 10% on top of that. So 10% per year for every year you delay when you're supposed to start it. Now, interesting side note, I had a question once from someone who planned to move back to, I forget what country it was, Philippines perhaps, and lived and worked here for most of her life, was retiring to the Philippines and therefore not going to be under the U.S. Medicare system, and asked, do I need to enroll, or am I going to be penalized? The answer is, if you don't ever plan on coming back and ever eventually enrolling for Medicare, then it doesn't matter. Yes, so long as you're still a citizen, you may not have to be a citizen, but let's assume that the qualifications you need to be a citizen. So long as you're still a citizen, even if you're abroad, the clock will start running on your delay penalty. So again, 10% per year in additional premiums for every year you delay, such that if and when you do eventually enroll, that premium is permanently tacked on. Now, if you're never coming back, or you're coming back and never enrolling in Medicare, then it doesn't matter. They won't come after you and say, hey, you owe us this premium, this penalty. They only do it if and when you do eventually enroll. Then they stick it to you with higher premiums for life. So one thing to keep in mind, for those of you that plan on leaving the country, never coming back, none of this really matters as far as Medicare goes. But if and when you do, don't mess around with delaying the start of Medicare if you think you plan on needing it at some point. Okay, so Julia, yes, taking the money from your 401k. So yes, Julia clarified the question was, what's the benefit of converting to a Roth versus just taking it from a regular tax-deferred account like a 401k or IRA? Hold on, another clarification here. So instead of moving funds from my 401k or IRA and converting to a Roth, if I just take the distribution, what are the tax implications? Great. Okay. Good question. Kind of and honestly, that's like the essence of taxes and retirement, right? It sort of all comes down to this. When you do take money out of a tax-deferred account, whether it's a 401k, IRA, 403b, for those that are teachers or certain public employees, that's the 401k equivalent for public sector employees. Federal employees, that's something called the TSP, Thrift Savings Plan. If you're self-employed, you may have what's called a SEP, or a simple IRA. The difference is you've never paid tax on that money. When you take it out, it's all 100% taxable at the time when you take it out. In addition to having to pay just the regular income tax based on whatever your tax bracket is, there's these other things that we're discussing, these other hidden taxes, if you will, that may kick in based on your level of gross income. So like last week, we talked about how much Social Security is taxed. That's a function of how much other gross income you have. Included in other gross income is 401k or IRA withdrawals, distributions. Same thing like today. These Medicare premiums we're discussing here are based on your taxable gross income. 401k withdrawals, IRA withdrawals, 457, TSP, 403b. Withdrawals from those are all included in your gross income. So in addition to regular income tax, you may get bumped into these other thresholds to have these other, I'll call them penalties or surcharges, applied to you, which is effectively increasing your overall level of taxes. So that's taken out of 401s. With Roths, the difference is you pay tax when you put the money in, or if you convert it, you take it from a regular 401 or IRA, move it or convert it into a Roth account. You pay taxes when you convert, at the time you convert, and the amount of the conversion is indeed included in your gross income for that year. So that comes back to some of these questions. If I do a conversion this year, is it going to potentially mess up my Medicare premiums in 2 years? The answer is yes. If that conversion plus your other income puts you over the thresholds, then yes, you'll have these surcharges to pay. But the planning and the balance of, like I mentioned last week, picture financial planning as seesaw. Everything you do to help the current you takes away from the future you, and everything you do to help the future you is at the expense of the current you. The goal is trying to find that balance, right? Pay some taxes now, but not too much. Don't stuff yourself having to worry about taxes 10, 20, 30 years from now in retirement when you don't know what taxes are going to be. We know what they are now. Why not use that and have some more control over when we pay taxes and how much we pay? So that's sort of the logic behind Roth conversions. We know what it's going to do to us now. Let's do it now. Let's bite that bullet now. Once the money converted to the Roth, has taxes paid on it today, and it's invested in the Roth, that money now grows tax-free and will eventually come out tax-free, assuming you meet a few criteria, which I'm going to do live on this. There's a lot of sort of rules and what-ifs to know about when Roth withdrawals are qualified to be tax-free, but let's assume you meet those qualifications. When you take the money out, not only do you not pay income tax at the time, but it also does not count for purposes of these thresholds that we're discussing today, or the thresholds we discussed last week about Social Security taxation. So that's the beauty of the Roth. Pay tax today, don't pay any tax again, and those withdrawals you eventually take out of the Roth will not potentially ding you with these other thresholds. That's how it helps you. Now, for estate planning purposes, Roths can also help, I'm getting off on a tangent, but Roths can also help whoever eventually inherits your money, whether it's children, friends, siblings, doesn't matter. People, when a Roth account is inherited, they don't have to pay tax on it. There's one exception where they do, but that doesn't apply to most people, and it's outside of the scope of this. But assume people who inherit a Roth account will never have to pay income tax on it, versus when they inherit a tax-deferred account, like your IRA, like your 401k, et cetera, that's all 100% taxable income to them. So like an estate planning angle here, if you have kids, let's say, you're probably 60, 70, 80, hopefully older when you eventually pass, you could be potentially in a very low tax bracket as a retiree, potentially. Versus your kids, they may be in their peak earning years. So if you have an IRA and you die, it goes on to your kids, you could be stuffing them with a bunch of additional income they'll need to take out on top of their already potentially high salaries and whatever. You can kind of do them a favor as a family, and you can bite the bullet and pay some of the tax now as a retiree at a relatively low rate to get it into a Roth, so that when you die and that Roth ends up to your kids or whoever else it's going to, they won't have to pay tax on it. Just another thing to consider in the whole scheme of planning. Does that answer your question, Julia? There's more technicality to it than that, but that's sort of the gist of why would someone do a Roth conversion. Pay taxes now, save yourself taxes, and possibly other penalties and surcharges in the future. Sometimes when you retire, the company may want... Oops, sorry, the question just moved. Again, these questions are on like a 15-second delay, so apologies if I'm a little late in getting to them. Sometimes when you retire, the company may want you to take the whole amount of your 401k. If you transfer to an IRA and then do a Roth conversion, that'd be better. No, it doesn't matter. So think about 3 buckets of account types: tax deferred, Roth, and regular brokerage account. Anything tax deferred, whether it's 401k, IRA, 457, TSP, 403b, etc., those are all the same, and you can move money interchangeably between them without any tax implications. Now, it's a little more to it than that. You have to do a direct transfer often, but assuming you do the transfer correctly, you can easily move money from your 401 to an IRA. So yes, some employers when you leave want you to take the money out of their plan because it costs them in record keeping and administrative fees for every person they have participating in the plan, especially smaller employers. They may not want it. If you work at a big, multi-thousand person company, they'll have large, well-administered, relatively cost-effective plans that they'll be fine if you keep it there. But assuming your employer wants you to take your 401 out when you leave, you don't have to take it out and use it and pay tax on it. You can simply roll it to an IRA, no tax implications at the time. You're just moving that lump of money from one tax-deferred bucket to another. The important thing is it's still in that tax-deferred world. Once you move it out to a different account like a Roth, yes, you pay taxes upon moving it or converting it to the Roth. Same thing with moving it to a regular normal brokerage account. Once you take the money out of that tax-deferred world, you owe taxes on it. Cool? Man, questions are coming in. Awesome. So yes, okay, Julia, that was your question. Marianne, I had asked this on a previous page and you responded that you have a sheet that looks like a tax return where you can predetermine in December what my taxes will be. Due April, are you able to share a sheet like that? The reason I ask, let's have to expand this question. The reason I ask is that I'm always unsure what to expect from my tax amounts until I do taxes the following April, and I'm interested in going heavy on wealth conversions because most of my portfolio is in traditional IRA. I'm 68, married, filing jointly. Yes, I have a sheet, and unfortunately now I'm not willing to share it because I don't want to possibly take on the liability or the trouble, and I'm not hinting you don't know how to use Excel or anything like that, but it's possible I made an error in the formula, or it's possible someone who uses it doesn't use it correctly, and I can't take on the liability of someone coming back and say, hey, this sheet you gave me showed me I can convert $12,000. Well, I did, and guess what? I got a nasty tax surprise. So unfortunately for that reason, I'm not willing or able to share the sheet I made. It's proprietary to me, and I don't want to run the risk of others using it in case it's wrong. I made it wrong or whatever else. But you can Google, I forget the name of it. Take notes. There is a sheet that is available that's basically the same thing I did. I don't remember what website it's on, but I will try to find it. Then I will post the link to you if and when I find it, Marianne. I'll put it in the chat so everyone has it. But that's not me, so I can sort of absolve myself from anything being wrong or incorrect with that sheet. But for my own sheet, I'm sorry, but I'm not able to share that. Okay, Julia. Okay, so it's basically the growth of the money in the Roth being non-taxable that is the benefit. Got it. Yes, exactly. Great. Okay. So, great questions. Thank you. We got another 13 minutes here. Just to comment one more thing about this two-year look-back rule. Again, your surcharges are based on your income 2 years prior. I'm parched. So what often happens, and this happened to my father, for example, made pretty good money while he was working, retired, started Medicare 2 years later, and guess what? He had really relatively high surcharges added onto his Medicare premiums because they were looking at his income from 2 years prior when he was in his final year of work, peak earning years, making good money. Now, meaning 2 years later when he was on Medicare and retired, his income was a fraction of what it was a couple of years prior. Thankfully, there's a way you can get around that. You can say, hey, my income then is nothing like it is now, therefore it's unfair. Sorry, another do not say this. Okay. The Social Security Administration Medicare system is kind enough that they will there's 8 excusable, what they call life-changing events that they will let you say, hey, my income from 2 years ago is not indicative of what it is now, therefore it's unfair that I should pay increased premiums as if I'm still making that higher level of income. I will share with you what those 8 are, and the form you use to, I don't want to say challenge it, I think it's called reconsider, might be the technical term, to get your IRMAA surcharges reconsidered, is form SSA4. This is just a snippet from it. It's 8 pages. You can Google this. It's free. You can find it easily. Basically, you would say, hey, wait a second, I retired 2 years ago. I shouldn't be paying these high premiums, and you'll have to give an estimate of what your gross income is now, 2 years forward, when you're actually getting these surcharges, so they can reassess it. So the 8 life-changing events that qualify are marriage, divorce or annulment, death of your spouse, work stoppage. That's where retirement comes in. So, you were working 40 hours a week 2 years ago. You've since stopped, and your income went down precipitously. That's work stoppage. Work reduction. So you don't have to all out stop working completely. Maybe you just reduce your hours, or you're transitioning into retirement, which is a good strategy for not just financial but sort of emotional and mental reasons. You go from working 40 hours a week to 30 to 20 to 10 and sort of slowly glide your way out the door. That would be work reduction. Loss of income producing property. This one gets some people. So if you own a rental property, let me just go through the other two quickly. Loss of pension income, so you have a pension and the plan goes bust and your payment goes away, for example, that would be that. Or employer settlement. Let's say your employer went bankrupt and you got a one-time big fat payout 2 years ago. You can say, hey, that was a one-off fluke event. That I don't have that going forward. So let me tweak my IRMAAs. So I want to go back to the loss of income producing property here. And again, it's only these 8 that qualify, nothing else, including not Roth conversions, which I'll touch on. So income producing property, let's say you own a rental property, and it throws off, I don't know, $20,000 a year, let's say. If you do, good for you, that's a lot. But anyway, if that's destroyed outside of your control by natural disaster or riots or whatever, you can say, I no longer have that property, it got destroyed, therefore it shouldn't be assumed that I have that same income now, because I don't, because the property blew up or whatever. That's a qualifying event that you can get your IRMAA reassessed. What's not a qualifying event is if you own a rental property and decide to sell it because you don't want it, or having tenants was a headache and you simply don't want that hassle anymore, and you choose to sell it. That doesn't count. If it's at your discretion that you sell or get rid of your income producing property, that is not a qualifying event. You will be stuck having to pay this premium based on your income 2 years prior from that rental, even though you no longer have it. Got it? So I mentioned Roth conversions. Those do not qualify. Even if it is one time, doesn't matter. That's something you consciously did. It's not going to get you a pass for getting your IRMAA reduced. So keep that in mind. I think I posted that on taxes and retirement before, but that's why Roth conversions do matter, because you have to pay attention to the thresholds. Again, don't let these be the deciding factor or the driving factor as to whether or not you do conversions, but just keep it in mind. If you are in Medicare or of Medicare age, conversions will increase your MAGI for purposes of these. Good. One more question here. Julia, yes, but if you have $100,000 in a 401k and move to IRA and then take out $10,000 for Roth conversion for each of the next 5 years, instead of having to take out the full $100,000 to do the Roth, that's what I meant, sorry. Oh, sure, yes. Yep, so again, you can always move money from one tax-deferred account type to another, 401k to IRA. Some companies will let you move an IRA into a 401k, but usually it's the other way around. You retire, you leave, you move it out of the 401 or 403 or whatever employer plan into an IRA. Within that tax world, there's no tax, assuming you do the transfer correctly. So yes, you could move all $100,000 from your 401 to your regular IRA, no tax implications, and then at your discretion, you can do Roth conversions out of that IRA, traditional IRA, into a Roth IRA. I don't think there's any minimum or maximum you can convert. You can do $1. You can convert $1 a year if you want to, or you can convert the full $100,000 in one shot. Now again, that's going to spike your income, increase your taxes, maybe put you over your thresholds. But you're free to convert as much as you want. You can do multiple conversions in a year. Some custodians may limit you. If you start converting $5 every day, at some point they may be like, hey, cut it out, this is annoying. But to my knowledge, I don't think there's restrictions about how much you can convert, when you can convert, or how frequently you can convert. Though again, every custodian is free to set their own reasonable sets of limitations. Hopefully that answered your question, Julia. Okay, looks like that is it. Great questions. Thank you, everyone. Just to recap, if you didn't see the post the other day, I will be a special guest on Retirement Starts Today Radio, which is one of my favorite podcasts. I'm not just saying that, it really is. It's one of 3 or 4 that I absolutely love and listen to regularly. Benjamin Brandt, the host of that, asked me to be on, and he wants to do a special episode where he and I sort of tag team listener questions. So he extended the offer to me, specifically to the tax and retirement group. So whatever questions you have, they don't need to be tax related. I think he and I may lean toward having the show and the questions be sort of tax themed. But if we don't get enough good tax questions, not to say bad ones, but we may loop in other stuff that's not purely tax related. So I already got 3 or 4 good questions, so thank you very much to those of you that posted them. I don't know when the show is going to be recording. He hasn't figured it out yet. I don't know what the schedule is, but once I know when it is going to be released, I will let you know. Again, so post whatever questions you have. And I hopefully you like these lives. I do plan on doing these every week. I have plenty of content I'd like to discuss. I'd like this to be as educational as possible. So with that said, I'd like to discuss what you all would like to know about. Otherwise, I have an endless list of things I'll gladly ramble on about every week. But if there's stuff you want to know about, just drop in the group, let me know, and I will prioritize those. I'll be making some sort of content calendar so you all know. Assume it'll be the same day, same time, so Wednesday, 8 p.m. Eastern every week, unless I'm away or whatever. May or may not be able to do it, but assume it's every week. And I'll be posting up a content calendar going out a month or two. So those of you that are interested in like these live things, you can look at the schedule and know, okay, in 3 weeks he's going to be discussing doing a backdoor Roth contribution, or things to know when taking money out of Roth IRAs, which I might do next week. That was a good one. Thank you to whoever brought that up. So you can see, so you don't have to hang out here every week just to see what I'm going to talk about. You can know in advance, so you can attend the ones you want to attend. All right, that is it. Thank you all for attending. It's been a pleasure. I really enjoy doing this. I get passionate and sometimes a little worked up about this stuff, but hopefully you find these valuable and my mannerisms don't distract from the content. But it's been fun. So with that said, I'll wrap this up and hopefully see you again next week. Take care.